Gold is not pulling back. Silver is not correcting. This is free fall, real time. While you're watching this video, screens refreshing, numbers disappearing, stops triggering, accounts getting margin called. And here's the strange part. This crash is not coming from demand. It's not coming from supply. It's coming from rules changing mid-game, from switches being flipped behind closed doors, from two exchanges on opposite sides of the planet, moving on the same day, paper collapsing, physical refusing to follow, one price screaming panic, the other whispering truth. And by the time you realize which one is lying, the exit door may already be locked, because what's happening right now is not meant to scare you. It's meant to remove you. And the reason this is happening before March, that comes next, might change how you see metals forever. Welcome to Market Metal. If you've been watching markets longer than most people have been alive, if you've seen cycles come and go, and you're still here because experience taught you patience, then do me a favor, subscribe, not because of excitement, but because calm understanding survives, crashes better than emotion ever will. And before we continue, tell me in the comments, where are you watching from today? The event, why this sell-off is not a normal market move. They were watching the screens refresh in real time. Every update showed the same pattern. Lower prices, broken levels, no pause, no bounce. Gold slipped through numbers that had held for years. Silver followed faster and harder. This was not the slow pullback traders expect after a long rally. It was not a controlled correction. It was a collapse driven by force, speed, and mechanics most participants never fully see until it is too late. From the outside, it looked like panic. Headlines spoke of fear, profit-taking, and exhausted momentum. But the behavior inside the market told a different story. This was not investors choosing to sell. This was investors being made to sell. In a normal market decline, buyers appear as prices fall. Long-term holders step in. Institutions scale positions. Liquidity increases. Price slows. None of that happened here. Instead, liquidity vanished. Spreads widened. Orders failed. Prices jumped downward in sudden gaps. These are not signs of opinion changing. They are signs of forced behavior. To understand why this matters, it helps to define what a real sell-off looks like. In a typical sell-off, investors reassess value. They decide risk has increased. They reduce exposure. The selling is uneven. Some leave, others stay. Price moves lower, but the market continues to function. This time, the market did not function normally. It broke in a very specific way. The speed was the first clue. Prices did not drift. They fell vertically. Support levels that had taken months to build were erased in hours. Technical indicators that normally slow price movement were ignored. Algorithms did not pause. Human traders did not react in time. The system moved faster than decision-making allows. The second clue was uniformity. Different products, different regions, different participants all experienced the same outcome at the same time. That rarely happens when selling is voluntary. Investors disagree, strategies differ, capital moves unevenly. Here, everyone was pushed in the same direction at once. The third clue was what happened to those who tried to exit. Many could not. Orders were rejected. Trading halts triggered. Some instruments hit limits and stayed there. This is not what happens when markets are simply repricing risk. This is what happens when stress overwhelms the system. Behind this event sat the futures market, where leverage quietly controls outcomes. Futures are powerful tools. They allow large exposure with relatively small capital. That efficiency attracts institutions, hedgers, and traders alike. But leverage comes with a condition. Control does not belong to the trader. It belongs to the exchange. When prices move sharply, exchanges can change the rules instantly. They can demand more capital. They can raise requirements overnight. They can do this legally, without warning, and without regard for market sentiment. When that happens, selling becomes automatic. As prices fell, margin requirements rose. Traders who had been correct on direction suddenly faced a different problem. They did not need better analysis. They needed more cash. Immediately. Those who had cash survived a little longer. Those who did not were liquidated by force. Their positions were sold at the worst possible prices, not because they chose to exit, but because the system removed them. This distinction is critical. A market driven by opinion can recover quickly. A market driven by liquidation must finish its process first. Liquidation continues until positions are gone, not until value is found. Many observers believed the worst had already passed. They pointed to a large down day and assumed exhaustion. Historically, that logic often works. Sharp drops are followed by relief rallies. But those patterns assume the selling pressure is emotional or discretionary. This selling was mechanical. Mechanical selling does not care about price. It does not respond to value. It continues until conditions are met. In this case, the condition was capital. When traders could no longer meet margin demands, their positions were closed automatically. Each closure pushed price lower, triggering more margin calls, forcing more selling. This feedback loop feeds on itself. What made this event different from previous episodes was frequency. Margin changes were not isolated. They came repeatedly in short succession. Each change reduced the amount of leverage the system could support. Each one removed another layer of participants. Over time, only the largest, most capitalized players remained. Everyone else was filtered out. This is why price action alone cannot explain what happened. Fundamentals did not suddenly weaken. Industrial demand did not disappear overnight. Mine supply did not surge. No major discovery flooded the market. None of the usual drivers of long-term value changed. Yet prices collapsed anyway. The explanation lies not in value, but in structure. The futures market is designed to clear risk, not to protect participants. When volatility rises, exchanges protect themselves first. They raise margins to ensure they are covered if traders fail. This protects the system, but it transfers stress directly onto traders. Those with leverage absorb the shock. Those without leverage watch from the sidelines. As the sell-off intensified, something else became clear. The decline was not evenly distributed across all forms of the metal. Paper prices collapsed faster than physical markets reacted. This divergence hinted that the stress was concentrated in financial instruments, not in real-world demand. That divergence would become more important later. But even at this stage, it suggested that the problem was not metals themselves. It was how they were being traded. The event also challenged a common belief among market participants. Many assume that if they are right on fundamentals, time will save them. In leveraged markets, time does not matter if rules change. Correct analysis cannot overcome forced liquidation. Survival depends on structure, not conviction. As the decline unfolded, comparisons were made to past crashes. Some cited historical sell-offs, others pointed to bubbles bursting. But this event did not match those patterns cleanly. It did not begin with euphoria. It did not end with capitulation driven by despair. Instead, it unfolded through policy decisions and automated enforcement. This is why calling it a normal sell-off is misleading. Normal sell-offs are negotiated by the market. This one was enforced by the system. At the center of this system sit the exchanges that govern futures trading, including Chicago Mercantile Exchange, which sets margin policy for many global contracts. These institutions do not predict price direction. They respond to volatility and risk exposure. When volatility rises, they act. Their actions are neutral in intent, but powerful in effect. When margin requirements rise rapidly, leverage shrinks. When leverage shrinks, positions must close. When positions close, prices fall. This sequence does not require panic. It requires math. As prices continued lower, the absence of buyers became more noticeable. Long-term investors waited. Institutions assessed. No one rushed in. They understood something many retail participants did not. In a forced liquidation event, there is no advantage to being early. Prices do not stabilize until the selling mechanism is exhausted. This waiting behavior reinforced the decline. Without bids, prices moved freely downward. Each drop triggered another wave of selling. The process repeated. What looked chaotic was actually orderly in its own way. The system was clearing leverage. It was removing risk. It was compressing the market back into a form it could control. This is not a failure of the system. It is the system doing exactly what it was designed to do. For business leaders and long-term thinkers, this distinction matters. Markets do not always move because value changes. Sometimes they move because rules do. Understanding which is happening determines whether a decline is an opportunity or a warning. At this stage of the event, one thing was already clear. The sell-off could not be evaluated by price alone. It had to be understood through mechanics, policy, and structure. Those who focused only on charts missed the cause. Those who understood the machinery saw that the event was not finished. The decline was not asking whether metals were worth less. It was asking who could stay in the market under new conditions. And that question would shape everything that followed. The mechanism. How margin policy turns markets into traps. They thought risk was already priced in. Volatility had risen. Positions had been reduced. Many traders believed the worst exposure had been managed, but the danger they faced was not visible on any chart. It was embedded in the rules of the market itself. The futures market runs on a simple promise. Control large positions with a relatively small amount of capital as long as certain conditions are met. That promise works in calm periods. It breaks during stress. When it breaks, it does not do so gradually. It snaps. At the center of this mechanism is margin. Margin is not a fee. It is not a cost. It is a security deposit demanded by the exchange to ensure that traders can honor losses if prices move against them. When markets are stable, margins are predictable. When markets become unstable, margins become weapons. In theory, margin policy is neutral. Exchanges raise requirements to protect themselves from default risk. In practice, rapid margin increases forced behavior. They do not ask traders to reconsider risk. They command them to produce cash immediately. That distinction matters. When a margin hike is announced, traders are given no grace period. They are not allowed time to transfer funds. They must meet the new requirement at once. If they cannot, their positions are liquidated automatically. The exchange sells their contracts into the market at whatever price is available. In calm conditions, a single margin hike is survivable. Most professional traders keep excess capital on hand. They plan for volatility. They assume rules might change, but this event did not involve one margin hike. It involved many, delivered in rapid succession. Each increase removed another layer of participants. First, the most leveraged traders were forced out, then those with moderate leverage. Then, even conservative participants found themselves under pressure. The market was not testing opinions. It was testing balance sheets. The process unfolded quietly at first. Margin requirements were raised incrementally. Each time, traders adjusted. They sold some contracts. They added capital. They reduced exposure. They assumed the cycle would end. Historically, it always had. This time, it did not. Instead of pausing, the increases continued. Week after week, requirements rose again. The space between announcements shrank. Traders who had survived one hike were confronted with another before they could recover. Capital buffers thinned, stress accumulated. Then the structure itself changed. The shift to percentage-based margins altered the game entirely. Under this system, margin requirements rise automatically as prices rise. The higher the price, the more capital is demanded. Even if a trader does nothing, even if their position is profitable, the required deposit increases. Success becomes a liability. This creates a self-tightening loop. Rising prices attract capital. Rising prices increase margin demands. Increased demands force selling. Forced selling pushes prices down. The system oscillates violently, not because value changes, but because leverage becomes unstable. For traders still holding positions when this change took effect, the trap closed quickly. Those who had ridden the rally suddenly needed far more capital just to stay in the same trade. Many did not have it. Their positions were liquidated, not at logical levels, but at moments of maximum stress. This is why the decline accelerated rather than stabilized. Margin-driven selling does not slow as prices fall. It speeds up. Lower prices reduce account equity. Reduced equity triggers more margin calls. More margin calls force more selling. The cycle feeds on itself. Observers who looked only at charts saw panic. Those who understood the mechanism saw inevitability. The exchange at the heart of this process was the Chicago Mercantile Exchange, which governs a large share of global futures trading. Its mandate is to maintain orderly markets and protect clearing members. It does not exist to protect traders from losses. When volatility rises sharply, the exchange's priority is survival of the system. Margin hikes serve that goal. They shift risk outward. The exchange remains solvent. Traders absorb the shock. This is not corruption. It is design. What made this episode unusual was not that margins rose, but how quickly and how often they did. Historical comparisons showed that similar periods of volatility had produced far fewer changes over much longer time frames. Here, the cadence was relentless. For participants, this meant there was no safe footing. Each attempt to stabilize positions was met with another rule change. The goalposts kept moving. Planning became impossible. As prices fell, something else occurred. Liquidity evaporated. This is a predictable outcome of margin stress. When traders fear forced liquidation, they stop providing bids. They step away. Market makers widen spreads. Depth disappears. Small orders move prices dramatically. This is why declines driven by margin policy often look irrational. Prices overshoot. Levels that should attract buyers fail to hold. The market does not reflect consensus. It reflects compulsion. Many traders learned this lesson the hard way. They had been correct on direction. They had anticipated long-term strength. Their analysis was sound. It did not matter. They were removed from the market by mechanics they did not control. This is one of the most dangerous misconceptions in leveraged trading. Being right is not enough. One must also survive. As the liquidation wave continued, the impact spread beyond futures. Exchange-traded products linked to metals experienced sharp declines. Some hit circuit limits. Others halted entirely. Investors who believed these products were liquid discovered that liquidity is conditional. When stress reaches a certain point, the promise of instant exit vanishes. Systems protect themselves, participants are trapped. This trapping effect amplified fear, but fear was not the cause. The cause was structural pressure. Traders who wanted to exit could not. Those who wanted to hold were forced out. Choice disappeared. From a strategic perspective, this reveals a deeper truth about modern markets. Control lies not with participants, but with infrastructure. Exchanges, clearinghouses, and margin committees shape outcomes more than sentiment does during extreme events. This is why the decline felt different from past sell-offs. It was not negotiated, it was imposed. As this process unfolded, attention shifted to a troubling signal. Margin policy changes were not isolated to one region. Similar actions appeared elsewhere, nearly simultaneously. Markets that normally move independently were suddenly aligned. That alignment raised a critical question. Why would separate exchanges, operating under different jurisdictions and facing different political realities, respond in the same way at the same time? The answer was not visible yet, but the implication was clear. The risk they perceived was not local, it was systemic. For now, the mechanism continued its work. Leverage was stripped away. Positions were closed, prices fell. The market moved closer to a point where only the strongest balance sheets remained. Those watching closely understood that this phase had to end before anything else could begin. Forced selling cannot continue forever. Eventually, there are no positions left to liquidate. But before that exhaustion point arrives, damage accumulates. Traders are removed, confidence erodes, trust in price signals weakens. This is the hidden cost of margin-driven events. They do not merely reset prices, they reshape participation. For business leaders and long-term investors, the lesson is not about timing trades. It is about understanding power. In moments of stress, markets do not reward insight. They reward resilience. And resilience depends on knowing where the real leverage sits. As the second phase of this event unfolded, one thing became undeniable. The sell-off was not the result of changing beliefs about metals. It was the result of a system enforcing new limits. The next question was unavoidable. If this pressure was being applied in multiple markets at once, what threat were those markets responding to? That question would lead directly to the most unsettling part of the story. The coordination signal. When independent systems move in lockstep, they had seen volatility before. They had seen crashes. They had seen margin hikes, emergency meetings, and sudden rule changes. But what they had never seen was this: two rival financial systems reacting in the same way, on the same day, for the same reason. Under normal conditions, global exchanges behave independently. Each responds to local liquidity, regional demand, political pressure, and domestic risk. Even during crises, their actions are staggered. One moves first, others follow days or weeks later. Coordination is rare, informal, and usually denied. This time, there was no delay. As margin requirements rose in the United States, a similar move appeared in Asia. Not quietly, not gradually. It happened openly, decisively, and in the same direction. For analysts who track market structure rather than headlines, this was the moment the story changed. The question was not whether prices were falling, that was obvious. The question was why two systems that compete economically, politically, and strategically would act in harmony. The exchange at the center of the Asian market response was the Shanghai Gold Exchange, a critical hub for physical metals pricing and settlement. Its actions carry weight not just within China, but across the global supply chain. When it adjusts margin requirements, it sends a signal far beyond its borders. On the surface, the justification was simple. Volatility had increased, risk management demanded tighter controls. That explanation satisfied casual observers, but for those who studied timing and incentives, it raised more questions than it answered. Why now? Why the same week? Why the same direction? And most importantly, why margin tightening rather than trading halts, position limits, or settlement changes? To understand the significance, one must understand what margin policy represents. It is not merely a safety measure, it is a defensive response to a specific fear. The fear that the system may not be able to honor its obligations if participants demand more than it can deliver. That fear does not arise from falling prices alone. Falling prices reduce risk for sellers. They increase stress for buyers, but they do not threaten the exchange itself. The threat comes when positions remain open into delivery periods, and participants insist on fulfillment rather than cash settlement. This is where coordination becomes meaningful. Exchanges do not coordinate to control price. They coordinate to control exposure. When two independent systems act together, it suggests they are responding to the same underlying pressure, one that transcends geography and politics. In this case, that pressure was delivery risk. Futures markets are built on a critical assumption. Most contracts will be settled in cash. Physical delivery is allowed, but rarely demanded at scale. The system works because only a small fraction of participants ever ask for the metal itself. When that assumption is challenged, the system becomes fragile. As prices rose earlier in the cycle, interest in physical settlement increased. Industrial users, sovereign entities, and large institutions began securing supply rather than rolling contracts forward. This behavior does not show up clearly in daily price charts. It appears in warehouse data, lease rates, and delivery notices. By the time margin policies began to change, these signals had already been flashing. The problem was not that prices were high. The problem was that too many participants were positioned for delivery at the same time. From the perspective of an exchange, this is a worst-case scenario. Exchanges are intermediaries, not producers. They facilitate trades, but they do not create metal. If delivery requests exceed available inventory, the credibility of the system is questioned. This is where margin policy becomes a tool of prevention. By raising margins aggressively, exchanges force participants to reduce exposure before delivery windows open. They make it expensive to hold positions. They pushed traders toward cash settlement or exit. In doing so, they reduced the number of contracts that might result in physical demand. Seen through this lens, the coordinated margin hikes were not about calming volatility. They were about avoiding a bottleneck. The alignment between Western and Asian exchanges suggested that both were facing similar calculations. Vault inventories were tightening, physical premiums were rising, lease rates were climbing. Demand for real metal was increasing, even as paper prices wobbled. This divergence created a dangerous imbalance. In efficient markets, paper and physical prices track closely. Arbitrage keeps them aligned. When that link weakens, it signals stress. It suggests that one side of the market is no longer confident in the other. As paper prices fell rapidly, physical prices did not follow at the same pace. In some regions, they barely moved at all. Buyers continued to pay premiums. Sellers did not rush to offload inventory. This behavior contradicted the narrative of collapsing demand. For exchanges, this was alarming. If paper prices fall, but physical demand remains strong, delivery pressure increases. Traders see an opportunity. They buy futures cheaply and stand for delivery, acquiring metal below real-world prices. If enough participants do this, inventories drain quickly. This is the scenario exchanges are designed to prevent. The response was swift. Margins rose, access tightened, leverage shrank. The cost of holding positions increased dramatically. Traders who might have considered taking delivery were forced to reconsider. From the outside, it looked like chaos. From the inside, it was a controlled burn. The coordination also revealed something else: information asymmetry. Exchanges have access to data most participants never see in real time. They see positioning, they see delivery intentions, they see stress building before it becomes visible to the public. When two exchanges act simultaneously, it suggests that their internal data pointed to the same risk. This does not require conspiracy. It requires shared incentives. Both systems depend on confidence. Both depend on orderly settlement. Both depend on the belief that contracts will be honored without disruption. When that belief is threatened, defensive action becomes rational. The troubling part for participants was timing. These actions occurred just weeks before major delivery windows. That timing was not accidental. It reflected urgency. For traders caught in the middle, the effect was devastating. They faced pressure from all sides. Prices fell. Margins rose. Liquidity disappeared. Exits closed. Survival became the only objective. Many asked why exchanges did not simply raise margins earlier or more gradually. The answer lies in optics. Sudden aggressive moves draw attention. They expose stress. Delaying action can preserve calm until intervention becomes unavoidable. By the time margins rose in unison across regions, the decision had likely already been debated internally for weeks. This realization changed how serious observers interpreted the sell-off. It was no longer a question of whether metals were overvalued. It was a question of whether the system could handle the positions that had accumulated. For business leaders and institutional investors, this distinction is critical. Market prices are signals, but they are not always truthful. Structural actions reveal more than headlines ever will. The coordination signaled that something beneath the surface was straining. It suggested that physical demand, delivery obligations, and inventory constraints were converging in a way that paper markets could not easily absorb. As the sell-off deepened, one truth became unavoidable. The decline was not a verdict on metals. It was a maneuver to manage risk before a deadline. What that deadline represented would soon become clear. And with it came the most revealing contradiction of all: the growing gap between what paper markets claimed metals were worth and what physical buyers were actually willing to pay. That gap would expose the fault line running through the entire system. And once seen, it could not be ignored. The divergence. When paper prices collapse, but physical reality refuses to follow. At this stage, the sell-off had already done visible damage. Prices were lower, positions were gone, confidence was shaken. But beneath the surface, something far more important was happening. Something that did not fit the narrative of a genuine market collapse. The paper price was falling fast. The physical market was not. This divergence was the final signal that the event unfolding was not a verdict on value, but a conflict between two systems that only appear to be the same. In financial markets, metals trade in two parallel worlds. One is paper-based, driven by futures contracts, leverage, and cash settlement. The other is physical, driven by real demand, logistics, storage, and delivery. In calm periods, these two worlds move together. Arbitrage keeps them aligned. Price differences are small and temporary. During stress, that alignment breaks. As paper prices fell sharply, physical buyers did not retreat. In some regions, they increased activity. Premiums rose. Delivery requests continued. Inventory withdrawals accelerated. These behaviors are incompatible with the idea that silver and gold were suddenly worth much less. If metals were truly overvalued, buyers would step back. They would wait for lower prices. They would demand discounts, not pay premiums. That did not happen. Instead, the physical market sent a different message. It treated the price drop as an opportunity, not a warning. This contradiction exposed the core tension in the system. Paper prices were being forced down by margin policy and liquidation. Physical prices were being supported by real-world demand and constrained supply. One reflected leverage, the other reflected reality. The most striking evidence came from price gaps. In efficient markets, a large gap between paper and physical prices should close quickly. Arbitrageurs would buy the cheaper side and sell the more expensive side, locking in profit. That mechanism relies on two conditions: access to both markets and confidence in settlement. During this event, both conditions failed. As paper prices collapsed, physical prices remained elevated. The gap widened rather than narrowed. This meant arbitrage was not functioning. Participants either could not access physical metal at paper prices, or they did not trust that paper contracts would reliably convert into delivery. That loss of trust is rare. When it occurs, it signals systemic stress. For exchanges, this is the danger zone. Futures markets are built on credibility. They work because participants believe that paper claims represent something real. When that belief weakens, the system's foundation cracks. The response to this risk had already begun in earlier phases: margin hikes, tighter controls, reduced leverage. Now the effect became visible in the divergence itself. As physical premiums rose, vault inventories declined. Metal was not being traded back and forth on screens. It was being removed, transported, stored, and used. These actions require planning, capital, and intent. They are not driven by short-term speculation. Large withdrawals from vaults are especially telling. Removing metal from an exchange warehouse is expensive. It requires logistics, security, insurance, and storage. No one does this casually. When institutions take delivery at scale during a price collapse, it signals confidence, not fear. This behavior also revealed who was acting. Retail investors do not move millions of ounces. Industrial users, sovereign entities, and large funds do. Their timelines are long. Their decisions are strategic. They are less sensitive to short-term price volatility. While leveraged traders were being forced out of paper positions, these participants were stepping in quietly, acquiring physical supply. This transfer of metal from exchanges to private hands has consequences. Each ounce removed reduces the buffer available for future delivery. As inventories fall, the risk associated with outstanding contracts increases. The system becomes more sensitive to delivery demands. This sensitivity is reflected in lease rates. Lease rates represent the cost of borrowing physical metal. In normal conditions, they are low. Metal is abundant. Borrowing is easy. During this event, lease rates rose sharply. High lease rates send a clear message: physical metal is hard to find. Those who need it must pay up. No one pays elevated borrowing costs for something they expect to get cheaper soon. This again contradicted the paper price narrative. If silver were truly collapsing in value, lease rates would fall. Lenders would be eager to lease metal. Borrowers would wait. The opposite happened. The divergence extended beyond pricing. It appeared in market behavior. Physical dealers reported tight supply. Delivery times lengthened. Premiums persisted even as futures prices dropped. This resilience suggested that physical buyers viewed the sell-off as temporary and artificial. For analysts, this raised a critical question. If paper prices were reflecting reality, why was the physical market ignoring them? The answer lies in the different constraints each market faces. Paper markets can expand and contract rapidly. Contracts can be created and destroyed with a keystroke. Physical markets move slowly. Supply chains take time. Mines cannot increase output overnight. Refineries cannot accelerate production without limits. When paper markets are pushed by policy, they can move far away from physical fundamentals. That separation can last longer than many expect, but it cannot last forever. At some point, reconciliation is required. This is where the suspense of the event reached its peak. The system was now carrying a contradiction. Paper prices suggested abundance. Physical markets suggested scarcity. Both could not be true simultaneously. Exchanges understood this. Their actions in earlier phases were attempts to reduce exposure before this contradiction forced a reckoning. By forcing liquidation, they reduced the number of contracts that might result in delivery requests. By raising margins, they discouraged new positions. By tightening rules, they slowed the flow toward physical settlement. But these measures do not eliminate demand, they delay it. As delivery windows approached, attention turned to open interest. Despite the crash, a significant number of contracts remained open. This meant participants were still willing to hold positions into delivery periods. They had not been shaken out entirely. This persistence was dangerous for the system. It suggested that some participants were willing to endure volatility and margin pressure in exchange for the right to receive metal. They were not trading price, they were securing supply. This behavior undermines the assumption that most contracts will settle in cash. When enough participants reject cash settlement, the system's flexibility disappears. For business leaders observing this event, the lesson was sobering. Markets can be made to move, but they cannot be made to lie indefinitely. Policy can suppress price signals, but it cannot create metal. When physical constraints assert themselves, paper structures must adapt. Historically, such divergences resolve in one of two ways. Either physical prices fall to meet paper prices, indicating true demand destruction, or paper prices rise to meet physical reality, indicating that the suppression has reached its limit. Which outcome occurs depends on fundamentals. In this case, fundamentals remained strong. Industrial demand continued. Supply remained constrained. Inventories were falling. These conditions favored physical resilience, not collapse. This is why many institutional participants remained calm despite the chaos. They were not trading screens. They were assessing supply chains. They understood that forced liquidation does not change long-term scarcity. At the same time, they recognized the cost of surviving until resolution. Volatility can destroy those who are structurally exposed. Timing matters less than positioning. Leverage is punished. Patience is rewarded. As the sell-off entered this final phase, the market presented a choice, not explicitly, but clearly. Participants could focus on paper prices and react emotionally, or they could study the divergence and ask why physical behavior contradicted financial signals. Those who chose the latter saw a different story. They saw a system under stress, using policy tools to manage exposure ahead of a critical period. They saw metal quietly leaving warehouses. They saw premiums persist. They saw lease rates rise. They saw a gap that refused to close. This gap was not noise. It was information. It signaled that the sell-off was not a judgment on metals, but a negotiation between leverage and reality. It showed that while paper markets were winning the short-term battle, physical markets were holding their ground. The outcome of that negotiation was not yet decided. Damage had been done. Trust had been shaken. Participants had been removed, but the core contradiction remained unresolved. Paper and physical cannot remain divorced indefinitely. One must adjust. For now, the system had bought time. It had reduced exposure. It had pushed prices lower. It had forced capitulation. But it had not changed the underlying facts. Metal is finite. Demand is persistent. Supply is constrained. As this phase concluded, one truth stood above all others. Crashes do not destroy wealth. They transfer it. Those forced out at the bottom transfer opportunity to those who can endure. When reconciliation comes, whether through rising paper prices or tightening physical supply, it will not reward prediction. It will reward survival. And survival, in moments like this, belongs not to those who react fastest, but to those who understand what is real when the screens say otherwise.